If you're looking at the GDP numbers for Canada and you're thinking to yourself that this is a great predictor of how the economy is going to develop over the next few months, you might be looking at this too closely. It could be a bit of a myopic view, so you need to step back and look at the larger picture, which will not be as rosy. Also in this video, we're going to talk about a total inventory overload specifically for condos all over Canada, but more specifically for Toronto and the GTA. And then we're going to tie everything together and talk about how things might develop into the fall. Canadian GDP shows huge growth, but 80% of it is now government. On the surface, Canada's economy is ripping higher. Annual real GDP growth climbed to 2.1% in Q2 of 24, higher than the consensus estimate. It follows 1.8% growth in Q1, which saw an upward revision from the 1.7% originally reported. By itself, obviously, it sounds like quite an accomplishment, but if you compare that with how much of the new spending is related to the government, and by the way, a report, I believe from Forrester from a couple of years ago, was talking about a 42% number, which is attributable to government spending when it comes to Canadian GDP. But also another thing that's equally worrying is the fact that the GDP per capita has actually been declining for quite some time. So when adjusted for population, the picture isn't so rosy. Real GDP per capita declined 0.1% in Q2 of 24, with StatCan noting it was the fifth consecutive decline. Per capita growth fell in 7 out of the past 8 quarters, marking a recession by some definition. So the only thing we're arguing is about the definition of a recession, but it enters the conversation nonetheless every single time we're talking about the GDP and the Canadian economy. It does feel like a recession. It does seem like it to the majority of the population, and the only people that are still arguing about definitions are the economists and pundits. Let's look at this chart where the GDP growth is depicted by navy blue bars and GDP per capita is in orange. As you see, we're in a negative territory over the past 5 quarters. 1, 2, 3, 4, 5. And with that sort of a performance, it really puts a damper on the GDP numbers itself because it renders them kind of meaningless. Although slightly above expectations, the details behind the Q2 GDP increases are softer than the headline growth rate, and per person output continues to decline. And that's coming from an economist at RBC. She also adds the details are not as strong as the headline number. By our count, the surge in government spending accounted for 80% of the Q2 GDP increase. This is ludicrous. 80% of the spending as it relates to GDP has to do with the public sector. In the past 4 years, the Canadian government had printed in excess of $800 billion, and that's with a B, which is an increase of the entirety of the Canadian money supply by 40% in 4 years. In addition to that, we're allowing about 1.5 million immigrants into the country, both temporary and permanent, which would have been okay, but the productivity in the economy cannot absorb, or rather the productivity is low and the economy cannot absorb that number of newcomers while still churning out positive results for the GDP per capita. So things are not actually looking great in the Canadian economy at all. Canadian housing investment slowed further despite spending billions in taxpayer stimulus. Residential investment fell 1.9% in Q2 of 24, marking the most significant drop in over a year. Leading the decline were new construction, minus 1.6%, renovations, minus 2.6%, and ownership transfer costs, minus 1.1%. On the upside, though, it wasn't all bad. Canada saw a big improvement in at least one area, and that's inflation. Indeed, this is true. Inflation was last recorded at 2.5%, which is very close to the target announced by the BOC a couple of years ago. And they were planning to bring inflation down to 2%. So we are actually almost there. And since inflation is a lagging indicator, it might get there without further rate cuts. In fact, if the rate cuts are not substantial enough every time there's an announcement, we might get well below the 2% watermark that the Bank of Canada had identified some time ago, and might even go into negative inflation territory, which is bad news for the government that has to repay its debt. And if the inflation is negative, then it makes it more difficult to make those repayments. Canada may have printed impressive headline growth, but this was not a great quarter. Productivity is on the slide, job vacancies are falling, and unemployment is rising. Real GDP growth was 80%, one more time. What a number, due to rising government consumption and the rapid expansion of administration is now Canada's primary job maker. It's not officially a recession, but excluding aggregate GDP, this is what a recession looks like. So, let me read between the lines. This is actually a recession that we're in. Well, the struggling Canadian economy is leaving its footprints everywhere, and this is especially evident in real estate in large metropolitan areas like Vancouver and Toronto. So let's take a closer look at what's happening in the Toronto real estate. And that's from the Toronto Star. Toronto area new home sales continue to plummet and hit all-time low in July. There were 654 new home sales in July, down 48% from the same time last year and 70% below the 10-year average, according to a Wednesday report from the Building Industry and Land Development Association. Further expected decreases in interest rates in the coming months, along with the elevated inventories, means there will be plenty of opportunities once consumer confidence improves. And this is the key phrase in this article, consumer confidence. I always like to think about these as a trifecta. There are three variables that are chiefly responsible for the well-being of the real estate market. It's the real estate prices themselves, and based on some reports, they need to fall by a further 12% in order for prices to start making sense to consumers. I'm not sure if this number is correct or has any degree of accuracy, but definitely at the prices where they're at right now, real estate is not attractive to buyers, and they've been showing it to us all over the summer. Second thing is the interest rates themselves. And here the estimates suggest that the interest rates need to fall below 3% in order for the market to get revitalized. Okay, that could be accurate, below 3% coupled with the lower prices for homes. And the third thing that is as important as the first two is the consumer confidence itself. So what is that? It's a soft variable. When you're going outside to a grocery store or a gas station, when you're listening to the news, when you're reading the newspapers, when you're hearing about where the Canadian economy might potentially be going, it doesn't instill you with confidence as to what's going to happen in the next few months. So that's your consumer confidence at work. And right now it's very low. The buyers are very quiet. They're sitting on the sidelines looking at what might happen in the next few months. Total inventory of newly built homes crept up in July due to ever dwindling sales. There is now 15 months of inventory, the time it would take to sell inventory based on current demand on the market. Okay, so the level of inventory that we have in the marketplace right now would dissolve given the current very low level of sales within the next 15 months, which is quite incredible. This is definitely a buyer's territory. There's lots of options for buyers to consider. There is lots of over-leveraged sellers all over the place in all types of property, and it includes end users and investors, and it just takes an effort and some knowledge to fish out gems of a deal in this marketplace. Condominium apartments, including units in low, medium, and high-rise buildings, as well as stacked townhomes and loft units, accounted for 287 units sold in July, down 67% from July of 23 and 81% below the 10-year average. And out of all the condominiums out there, the segment of the condo market that suffers the most relates to new construction. The builders are taking a hit. Potentially banks are taking a hit with builders that are going into receivership, and certainly consumers that had purchased those units at prices that were projected 3 or 4 years ago to be at around $1,200 a square foot by 2024 are now getting surprised when the appraisals are coming in at $900 to $950 a square foot. So no happy campers in that segment of the market. Changes in interest rates will not solve what is an ongoing structural problem, particularly evident in the GTA. The cost to build, driven by excessive government fees and taxes, is simply too high. Without immediate action by government, new construction activity will continue to slow, and the GTA's housing shortage will reach unprecedented levels over the next few years. Well, let's take a closer look at that. Back in 2019, government fees and levies to start a new construction condo project per unit, and we're talking about an average sized unit with the most common set of features, a one-bedroom. So the government fees and levies would have set you back $40,000 approximately as a developer. Now, fast forward 4 or 5 years, the same set of fees would cost you $60,000, which is a 50% increase. In addition to that, prices for labor have increased by roughly 30% because over COVID, builders had to bid up their prices to bring in qualified hands on their sites. So that has increased by quite a wide margin. 50% for government fees and levies, 30% for labor force and about 50% increase for commodities like concrete, lumber, and steel. And despite government's repeated promises that as soon as the supply chains will normalize and they were disrupted due to COVID, prices will start coming down. But as soon as there is an opening and the government has an opportunity of actually passing those savings on to consumers, what do? They bring in more taxes. Case in point, recent announcement from last week of a punitive tax imposed on Chinese imported steel. We're talking about a 25% increase for steel imported from China. And where does the steel get used? In building construction. It's the cheapest supply of steel out of the four that Canada is customarily using: United States, South Korea, and Brazil. China being the least expensive, and it's being now taxed at 25%, higher rate than before. And that is effective as of October 1st. So what does it do? It marginally increases the cost of commodities used in construction by a further 25%. So instead of rather talking about the increase of roughly 50% for lumber, concrete, and steel over the past 4 years, we're now talking about maybe an increase of 55 to 60%. So the starting point for builders to start erecting buildings is creeping higher and higher with every year. Actually, if you look at the government announcements more closely, both for the province of Ontario and the province of BC, it seems that new taxes and new charges are being implemented every quarter. Without immediate action by government, new construction activity will continue to slow, and the GTA's housing shortage will reach unprecedented levels over the next few years. This is not a charity. Developers and builders only build when it makes sense for them, when the end prices justify the input price. And if the input prices are too high and the end prices are actually in the gutter, then the developers will simply not build, no matter the government incentives and the promises by both the federal and municipal governments. So there's going to be a gap in building. Housing starts are actually falling. And even though we have 15 months of inventory to dissolve at the current level of activity in the marketplace, once that inventory is bought out and new houses are not brought to the market, we again going to have a housing shortage which will precipitate further price growth. This will not happen over the next couple of years. So those of us that are thinking, okay, maybe in 6 months' time, the prices will start creeping up, or rather shooting up like what we had back in 2016 and 2017, or during the pandemic, I don't foresee this happening. But after a couple of years, with the way things are going, yes, we will continue seeing prices that are increasing. If I got you even a tiny bit concerned about what's happening in the real estate market, you might want to take a closer look at what's happening within the condo space, because condo space is an all-important link that connects a lot of different pieces of the real estate market together. And there's a big storm that's brewing within the condo part of the marketplace. It looks like we might be heading for a cliff. There are two things that I didn't really talk about in this video. One is there is a ton of renewals that's coming between now and the end of 25. People that bought their homes 4 or 5 years ago are still going through the process of having to renew their mortgages over the next year and a half. And not everybody is going to be able to sustain a new level of monthly expenses after the renewal. So there could be an avalanche of new listings coming online for sale in this period of time. Second thing that's going on is there is approximately 40 to 50,000 new condo units that are coming online between now and the end of 2025. And those were by and large bought out by investors and end users about 3 or 4 years ago. Not everybody is going to be able to close on those units either. And the problem is, if the number of people not being able to close is above a certain threshold, and I believe that threshold is at 40%, then developers themselves will be going into receivership, and then banks will be calling on loans that they've extended to those developers. And those properties are going to be coming online from banks. They will be repossessed by banks, and the banks will be selling them at any price the market can give them. They simply don't want to keep them on their balance sheets. This is not their business. That will crash the market. It will impact all other property types. So if the condo segment of the market crashes and burns in the next few months, we'll have issues elsewhere, and those issues are going to be quite severe. So we have to be watching this segment of the market very closely. So guys, with all of that said, if you like the content that I've given you in this video, you can hit the like button, consider subscribing to the channel, because these types of updates on the economy and the real estate market, particularly for Toronto and the GTA, are coming out on a weekly basis. I'm looking forward to seeing your comments in the comment section below, responding to them and engaging you in a conversation there. And also, if you want to have a 15-minute phone conversation with us, where we'll give you a free consultation on what you might want to do, whether you are planning to undergo a buyer's journey or you're thinking about selling, you can connect with either myself, Vlad, or my partner, Mitra. The link to our calendar is in the description below. The process is simple. You click on the link, you select the time that works for us, select the time that works for you, and we will have a chat. That's about it, guys, and I'm looking forward to seeing you again next week.